Hello and welcome to the M&A Science Podcast. This podcast is part of a mission to rethink how M&A is done. The old school seller-led approach, it's dead. Buyer-led M&A is all about strategy, alignment, and efficiency, putting value creation at the center of every deal. And let's be real, it's not just about closing the deal, it's about making it successful. We uncover what truly works in M&A by learning directly from the best. I'm your host, Kisan Patel, CEO and founder of Deal Room and chief scientist at M&A Science. Today, I'm joined by Xavier Gury, founding partner at Wind, a venture capital firm backed by both top-tier institutions and exited entrepreneurs across Europe and Asia. Before becoming an investor, Xavier was a three-time founder who exited companies to Publicis and L'Oreal, including one deal where he stayed through a performance-based earnout and helped grow the business from 100 to 250 people. In this episode, we're going to unpack what actually makes an exit successful, from deal structure to post-close execution. Now, Xavier now applies those lessons when backing the next generation of founders. Xavier, how are you doing?
I'm great.
Did I pronounce it right? I didn't get it quite right.
Xavier Gury, the French
Xavier
way.
Gury.
Thanks for having me here. Super happy to be there with you.
Hey, we're here live in Paris.
Yeah,
Right in the city center. Thanks for making the time. I really appreciate it.
My pleasure.
Could we kick things off a little bit about your background?
Yeah. So my background, I'm a computer science engineer. I chose to do that, to follow that path because I was a geek, the kind of geek that you call all the time to fix your computer. And also because I'm not coming from a rich family, and it was for me one of the easiest way to make money being a student. They had this biggest and this better best student organization where they propose work to students, and it was a good way for me to enter in the real life, working life. I did all kind of different jobs, from being in company training, Excel. I did my first training, I think, was on teaching people in company how to use AltaVista. So I'm talking only to the boomer like me, the old guys. AltaVista, this search engine on internet before even Google exists. I'm sure you remember, Kevin. So I was doing that kind of teaching. I even teach how to use a computer, Word, Excel to prisoner in jail for 6 months. So yeah, good experience. Learn a lot about myself, talking to people and about technology. And very quickly, I found myself being an entrepreneur. It was in the years 1999. If you remember, it was like this crazy time before the internet bubble, where a young guy, 19 years old, could just come up with an idea, a business plan, an Excel spreadsheet, and a PowerPoint, and convince business angels that was not so numbered at that time to invest in his company. So this is what I did. I jumped in when I was 19, funded my first startup, funded a few crazy business angels to follow me and this first idea. And then I launched my first company, raised my first round with Bernard Arnault, the CEO of LVMH.
Pretty well known, yeah.
Which at that time had a VC fund to invest in startups. As I say, it was at this moment, if you were not part of this movement, if you were not an investor in a startup, you were kind of a loser. So it was a time where it was kind of easy to raise money. Actually, too many money have been raised, and a lot of startups failed. And my first startup actually didn't work. So we raised something like 3-4 million euros. It was still the franc at this time, before the euros currency. And didn't work. Pivot. Started from scratch with Thierry, my partner, who is still my partner today. And ultimately, we turned the company, which was like a marketplace for knowledge management, into something more practical, which was how to make website, digital communications, working with luxury companies like Dior, Chanel, but also public institutions that had money at that time. And we ended up being 100 people by the end of 2007, and it was a good journey. I mean, we went through all steps of entrepreneurships. As I said, we raised, we pivot, we acquired a competitor that was filing bankruptcy, and ultimately we sold to Publicis, and we went through a 3 years earnout. So
Wow.
yeah, it was like a good way to learn about being entrepreneur, going through all the steps.
Yeah, you had a startup that didn't work out, and then you bounced back, did another one, and ended up having a successful exit. You had some other exits too.
Sorry?
You had other exits after?
Yeah, and then after that, if you want the full story, then I moved to San Francisco and Singapore. So first Singapore, I spent a few years there. We met other funders based in US and based in France at the time. My co-founder, Thierry, was in Shanghai, and we founded a perfume company that has been acquired by L'Oréal later. So this was another good venture in a completely different business, where the challenge was more like international deployment. We're also investor in that project, so also a good exit for us. And the funny thing, we did a third exit recently. If you remember the first business that didn't work, actually there was one side of this business which was like a translation company. It's basically having on board thousands of translators in their native language, and being able to connect them through a workflow to other people who need their service. And this part of this business worked pretty well. And so we sold it a few years ago to a German company. It was like our third exit together. So we had like 3 babies, and the 3 babies worked pretty well.
Wow. Okay. It's interesting how you expanded and got diversified in these different industries. Do you find that there's some fundamentals? I guess we'll talk more about this, but like that just generally apply from those early experiences, even though you're going different industries, or is it just you thrive off of learning new things, and that's what?
Your question is there any common denominator, like learnings from one business to another? They were like so different. Resilience is probably...
Well, the reason I bring it up is I feel like when I see a lot of founders exit, they tend to do the exact same thing again. You know, they'll wait till the non-compete runs out and then they do the exact same business again. I see that happen a lot more often.
Then it turned to be boring. I mean, I was happy to change of industry, and today, if I'm an investor, it's also another challenge. For me, it's a very entrepreneurial journey also. I mean, I find myself like fundraising a fund is very, very similar to fundraising a startup, except maybe it takes a little bit more time. Normally, a startup, you fundraise like in 6 months. A fund, it takes more like 1 to 2 years, depending on the market and how good and lucky you are. So, but it's the same exercise. I mean, you come up with an idea, you pitch, you adapt your pitch depending on how people react to the idea you propose. You reframe your deck, you go back pitching, and you try to convince people, and ultimately at the end you get the money and you have to execute your strategy. So it's very similar. I think one common denominator is, pitching. You have to like pitching. You have to like.
Yeah, that's true.
I mean, I find it like you have to have this like sell vibes inside you, because it's really the first steps, at least, raising money and convincing people, and then you have convinced startups. I mean. You have to enjoy pitching story and pitching business.
What's your secret sauce to pitching? Like, is it all about confidence in the story, or what have you found is like?
I don't know. I don't want to look like arrogant. I'm not sure I have a. I think listening. I think what I'm good at, but maybe I'm wrong. But I think where I'm good at is listening. My counterpart, my interlocutor, and adapting. I mean, understanding what my audience wants and adapting my speech to the audience. I don't think I have a very high IQ, but I think I'm pretty good on EQ, emotional quotient. I think I'm pretty balanced on the EQ and the IQ.
But a lot of these big investment decisions are based off of emotions most of the time, right? There's an element where the numbers got to line up, but then you got a lot of things that look alike.
Both, as you said, both are mandatory. I mean, if you let your emotions too much speak, you can just like jump on a project, on a deal that sounds amazing because it's going to cure cancer, but for many reasons, there is no economical rationale behind. So you end up losing your money.
You have to balance the two out. Can we take apart the Publicis experience? I like how you went through the whole journey. You went through a process. You ended up actually sticking around, which is what most buyers want, and you continued to grow and build success post close. Can we walk through and you mentioned too, you did an acquisition before you sold the business. So can we take that apart a little bit?
The acquisition. I mean, at that time,
and the business is more of like a digital agency.
Yeah, it was
right?
digital marketing and communication agency, and we were not the most shiny one. Our project.
What year was this when you started this?
France.
Which year?
So we started the business with the pivot was 2001. I think.
That's what I mean. So you're early, like digital agencies. Yeah. That's kind of a new concept back in 2001.
Yeah, it was at a time where making website was disruptive. It was complicated. There was no WordPress, Wix, whatever to help you to build your website. So you need technical competencies. And this is what we were bringing. And then you need to make a beautiful website. So you needed artistic directors, creative people. Then came the Flash. So what was interesting in that business is that you had to gather in your team competencies that were very versatile, coming from very good coder to amazing artistic director. And so we were not the most shiny. Our project was very public institutions, because at that time, they need their website, like all the city hall, all the cities, all the governmental agencies, they needed a website, very technical, and we were good at that. And the other agency we bought, they were just better from all sides, all angles. They were just better than us. Their name was better. It was W Cube, super name, like 3W. They were super competent. They were older than us. They have been part of a Swedish group that was a big, more than 1,000 people in that company, but they didn't manage well their cash, which we did well. We started from zero, but we grew it organically, and we were good at managing our cash, not picking up the most shiny project, like you're going to work for Dior, you're super happy, you can claim, but they don't pay you. And they're super demanding. And at the end, you spend half a year for a 50K project. So we focused on more like a rational and economical viable project. This worked pretty well, and it put us in a position to acquire competitors better than us when the market changed and where everybody was feeling bankruptcy. They were still like the good student like us to acquire them. And it was an interesting journey because I was like maybe 20, 21.
Wow.
And I was, acquiring a team. It was like 30, 40. I was like, I think the CTO at the time, and the guy we acquired from the team, he was a CTO with 10 years more experience than me, so obviously better than me. So there was like all this challenge of merging people together, with all this human relation that you have to handle, all this ego that you have to handle. And I think we're pretty well at doing it. Everybody needs to find his place. And I think this was one of the first milestones that we achieved, which was how to integrate people coming from another company, with your DNA.
But you guys were direct competitors.
They were like direct competitor.
Wasn't there like a negative sentiment that comes with it, like when you're bringing these people over?
At that time, the market was like super fragmented. There were competitors, but there was like thousands of competitors. And at the end of this market consolidations, only a few of them remained. And there was this kind of ego also for them, because we were like the small duck acquiring the giant dragon. But it worked pretty well. Everybody.
What was the headcount difference at the time of the acquisition?
In terms of people, so we were like 10 and They were like 100.
Wow.
So what we did is we kept, so when you save this company at the, the court, in France it's like court, we decide whether the company feel completely bankruptcy or you can keep some assets if you keep some people of the team. So in France, we have this like very favorable unemployment program, which means like if you decide to just being part of the bankruptcy, you take the money for 2 years, you are paid by the government, and that's one option. The other option, say you jump in this new venture with us, and you're gonna have to work, but you're part of a new adventure. And the good thing is the CEO of this company that we acquired was a super Iranian, super good commercial sales guy, very good business developer, not super good financial guy. But he joined us, and he helped us to select the best profile for the team he had. So we kept the 10% best of the team.
Okay, wow.
And that's why, in a team, there is always a range of quality of people and competencies, and we get the best. So we started with the best element of the former team.
This episode is sponsored by Deal Room. And if you're on the buy side, you know the pain. Most M&A tools, especially those clunky data rooms, aren't built for you. They're made for sellers, and it shows. Deal Room is the #1 platform built specifically for buyer-led M&A. It's designed to help you lead the deal from pipeline to diligence to integration with the structure and visibility you actually need. You get features like built-in project management, templated deal rooms, real-time collaboration, and AI contract review, all built to support how buy-side teams really work. No jumping between tools, no messy workarounds, and no hidden fees. Check it out at dealroom.net or click the link in the description to see how it makes buy-side M&A a whole lot easier. Lead the deal, own the outcome, here's to the deal. Was that like a big break, like a pretty pivotal change in terms of like direction and growth after you did that acquisition, or was it?
No, it was also the beauty of the deal was that we were also very complementary. We are very technical, and these guys, they were super creative. So we together it matched pretty well, and we were able to address the market with all what this market needed at the time: competencies that were super technical and competencies that were super creative.
And then we got to continue growth after this.
Yeah, so we grew from basically 20 to 100 when Publicis acquired us. So crazy time. I mean, we have always been like a perfect time to market. We raised capital from our first for first company in February 2000, just before the internet bubble burst, and we sold to Publicis 2 months before Lehman Brothers. So very good time to market, very lucky. But at that time, there was this like consolidation of the market. So all these big groups like Euro, RSCG, Publicis, Omnicom, BBDO, all these big advertising groups, they were super good at doing advertising in the metro, television, radio, but they were pretty bad at digital. And we were what at this time was called a pure player because we are purely digital. And they needed to acquire people like us. And for us, the question was whether we stay alone and we try to thrive, but then we're going to compete against this giant who are going to acquire competitors to be also a digital group, or they're going to develop internally their digital competencies. So for us, it was the right time, seeing this consolidation of the market, to say, okay, we need to join a bigger group than us, or we'll be a small player in a big world. And the customer we had, they were working with us because this big group didn't have the competencies. But once this big group will have the competencies, they will not work with us anymore because they will take what we call a 360 approach. These Publicis will propose a TV campaign, and on top of that, a digital campaign. And because they will have the competencies internally, they will not work with a small agency like us. So it was the right time to market, to join Publicis, another one. And we selected Publicis because they were the worst in digital. And we knew that the value added and our earnout will depend on how much we'll be able to to drive innovation and to drive digitalization in a big group. And actually, this is how our earnout was shaped at the end. So Publicis was not the biggest check upfront, but it was based on a formula. And I always tell to the startups we're working with that the value doesn't come only from the valuation, value of the deal, it comes from the terms. And in that case, the terms were pretty risky, but pretty favorable in case of a good execution. So we chose like the deal with the most potential, believing in us and believing we will be able to drive digitalization in a big group.
Did you run a whole process, like hire a banker and then, have all these bids come in?
So Publicis, they are doing, I don't know today, but at that time they were doing 10 to 20 acquisition every year. So they had a big M&A service.
They're already reaching out to you.
Yeah, and on our side we had nobody, but it's okay. We felt like we were in a.
How'd you get multiple offers? Did you hire?
Yeah. We had multiple offers, as I said, but Publicis was the best one in terms of potential. And the funny thing actually is, this is a funny story. At first, we were not supposed to be acquired by this entity of Publicis. So Publicis is a conglomerate. They have like more than 100 employees, I think, 100,000 employees today, with many agencies all over the world. And they had this, I would say that this internal agency dedicated only to production of digital assets. And at first, it was supposed to be this entity of Publicis that was supposed to acquire us. And I mean, we were okay. It was a good offer and everything was fine until one day we opened the TV and we see that our direct competitor, bigger than us, has been acquired by this entity of Publicis. So we were like, wow, okay, we are screwed. I mean, they choose another agency than us. And a few hours later, we've been called by Maurice Lévy, the CEO of Publicis, who told us, no, don't worry. I'm still acquiring you, but I will locate you, I will put you in the French entity of Publicis, which was actually much better for us because otherwise, first option would have been a small French digital player in a big digital group. And in the second case, the one that happened, we became the king of digital in a group that didn't do nothing in digital. So we were able to bring much more value. And I think this is the reason why also the earnout was like so good at the end. Many reasons for that. But one of them is that.
I still, no investment banker.
No.
So
actually, I don't consider myself a finance guy. I'm more like an entrepreneur.
Well, what I was wondering, okay, so no investment banker, but did you proactively go to other agencies to seek out offers or interests?
So they were looking for, everybody was looking for acquiring a pure player like us.
Oh, so you got a lot of inbound at
so
this
we
point.
got a lot of inbound, yeah.
This is good.
We didn't have to do too much work for finding the potential buyers. As I said, good time to market. And once the market knows that you are for sale, I mean, we had a lot of inbound from people, different profile of companies, some companies that were like pure technical companies, consulting firms, where the multiple of EBIT was like 5x, and because you didn't bring a lot of value. And other groups like Publicis, EuroSAG, Winderman, that were bringing more like a 10 to 12x multiple of EBIT.
Okay. And so
if you were bringing to them more value, it was like mandatory with more competition.
Yeah, and that's an interesting point, is looking from the buyer's point of view and how they value your business because of the synergies and what value add opportunities you would bring.
Definitely.
So you have one part of timing felt right. You're already seeing consolidation happening in the market, and to really compete on an ongoing basis, it would make sense to join a bigger platform. Then you got a lot of inbound interest. And with that, you sort of understand this perspective of different buyers putting value on it, and you're seeing a range. But then you mentioned Publicis wasn't necessarily the highest offer, but you did see that, hey, even though they bought another competitor, they wanted to put you in this different group where it's an opportunity to actually create more value just because they didn't have the capabilities and things that you were doing.
Yeah, this is in a way some luck, because I'm pretty sure if we had been picked up to be part of this operational part of Publicis dedicated to deliver digital asset, earnout would have been much lower. And in that case, being in charge of transforming a group that was purely focused on TV ads, traditional ads, to something that was digital, and ultimately at the end, it would be the digital that will drive and all the other assets. I don't know how to explain that. At first, all this group, they were coming with one creative idea that was made for TV. And then you were producing other assets for the subway, for the streets, for the radio. But everything first comes from the TV perspective. And when we left Publicis, everything was like a different paradigm. You first think on how we're gonna promote that brand, promote that product on internet with all the power of what you can do in the digital world. And after that, you're gonna think of how this can be advertised on TV, how this can be advertised in the subway. But it was a completely different process of completely different creative process, integrating the digital in the way you will promote a brand of a product. And this was our job for 3 years. It was to train the team in Publicis, to make them our best ally, to evangelize the customers and the whole group about how digital was powerful and how they should rely on us at Publicis to make their business. And obviously, the more digital business they were doing, the more business we were doing in the group. And the biggest was the earnout at the end.
It was like pretty transformative for them to acquire you as a startup and saying, hey, we're going to challenge our own business model. Instead of being TV first, we're now moving to more of a digital first approach.
Yeah, exactly. And if you ask me what were the different, why it worked, because ultimately the earnout worked pretty well. We know that when a company is taking over, like a small company is taken over by a big group, it's not easy. The size, the scale of the company completely changed. Your employees that were part of the family became part of a big group, so they became more like a number, whereas before they were like really part of the family. And it's really challenging. And in our case, it worked pretty well, I think, for many factors. One of them is clearly the human factors. The team within Publicis that took over a company had deep inside an entrepreneurial mindset. I think they could have been amazing entrepreneurs. They not decided to follow that path, and they had a great career. But they could have been an entrepreneur. I think they lived a bit this entrepreneurial journey through us, through our ventures, and our interests were completely aligned. And this is because the deal was shaped in a good way, where if we win, the group win, and the people who manage us on the day-to-day win. And there was this like alignment of planet and interest for everybody, where they had to make us thrive and being successful for them being successful. And this was really, it goes down to the way the deal was shaped, the formula of the earnout, etc. And another factor is you have to put a lot of energy. When you are a small startups, you are very lean. You try to save money on everything, and then you join this group, and they tell you to absorb, to embrace their process, which are not compatible with our way we managed the company before. I give you an example. we were using all our IT stack was open source, so cost zero. And you join this group, and the first thing they tell you, hey, every employee is going to have to to migrate on Lotus Note. I don't know if you remember Lotus Note. I'm not sure if that still exists.
Maybe.
But it was like Windows 365 before Windows 365, but the worst possible option. And the cost per headcount was like 1,000 euros per month per headcount. So it would have damaged our EBITDA too much. And so we had to fight to explain that, no, we don't want. We have to do a lot of politics and convince, and you have to have in front of you people that are ready to listen to you and understand. And we were listened, and we won a few battles that make the difference at the end, I think.
Yeah, that's it's interesting. So it wasn't the smoothest, but it sounded like there were some elements that allowed you to continue growing, which is for them just being more entrepreneurial minded, that, hey, we're acquiring the startup and we're going to learn from them. But then there's some points of friction you got to push back.
Yeah, definitely. I mean, and the thing also is like, I think what Publicis managed to do well is a lot of M&A firm, they make the deal, and what's happened next is not too much.
Exactly. They don't think about the after close.
And when it's like managed like the way they did it internally, I mean, I'm pretty sure they were incentivized on what the company will be in the next 3 years. And the success will not be only based on the signing of the deal, but what this merge will bring to the group 3 years later. And I think it helps a lot to make it successful.
So in terms of the factors that made the integration successful, right? You got the human factor. I want to talk more about just the way obviously there's compromises. So human factor, there's compromises. I want to talk about the deal structure, because that's interesting, because you even mentioned that you had a higher offer, but you took this one, you looked at the earnout being a bit more aligned for, post-close, and that's just opportunity to unlock more value. And I always think about these like dials of the deal, right? In this case, you have the valuation dial, right? What are we getting valued at? Then you got the terms of the deal, which in case this built-in earnout was one of the terms that was pretty favorable. And then you have, I feel like there's like the people factor, right? This, you kind of saw like, hey, these could be good people to work with. Sometimes they're not. You overlook that, and then it just turns into a total disaster because people talk about culture clash and all this stuff. How did you like think through that and I don't know, does that sound fair? Like to look at those sort of dials? Cause I want to reference us back on how you look at deals today when you're on the investor side and you're kind of coaching, an entrepreneur about thinking through exit. Is that the right dials that I should be thinking about, or am I missing anything?
I think one thing we've done pretty well at that time is to identify the 10 key people in the company from 20 years old coder, but we believed was key to build around him in the next years, to the business development guys that was like 45. And we incentivized 10 of these people, 10 key people in the company. And the way we did it is we asked, well, I'm not sure I'm gonna enter into the detail, but so we decided to incentivize the 10 key people of the company. And this helped us to have a core team fully aligned on the goals, and the goal was to maximize the earnout 3 years later. And it saves you a lot of challenge and a lot of problems. The first one being you have no more management issue managing these people. I mean,
so they're all
annual review are very easy because they are in the same boat than you. They are aligned. They have shares of the company, and they will benefit from the earnout at the end.
So they're all tied to the earnout.
So everybody is working head down to make sure that the earnout will be maximized. A good example is, what's the point of getting a very high salary if you believe in the exit, and if you know that the exit will be 10 to 12x the EBITDA. Okay, so for $1 you get a salary, is $9 you lose at the exit.
Right.
So no more fight on salary for the next 3 years. Everybody's aligned. We are not very well paid during these 3 years. Well, but not like amazingly well paid because we prefer to bet on the amount of the EBITDA 3 years later. So it makes like the management of the company very easy to do.
Was it easy for you to communicate with the because you found like 10 key people and
They were part of the team already, huh?
right, they're part of the team, but I mean, I find that sometimes even we have options for all employees in our company, and I can tell like some people value it and understand it, some don't. Where it's the mechanics, like, did you find yourself having to?
So it was before the stock option even exist. So it was like shares of the company. So same class of shares than us. No, stock options sometimes they are vested, etc., etc. In this case, they were like fully aligned with us, same class of shares than us, and
so they understood like, hey, we're going to optimize the business. We get hit this earnout, which is going to be a bigger win than just collecting a salary.
Yeah, it was for us, but what we decided is that us and also our business angels. Remember the crazy business angels from the beginning that bet on the first startups that didn't work? They were still on board. I mean, we kept them. The only thing we did is we acquired back our shares from Bernard Arnault when we did the pivot. I didn't mention that, but this was like the pretty smart move. We had almost all the shares of the company. The 35, or I don't know how Bernard Arnault LVMH had at the time, but we acquired back our shares before to do the pivot, telling them that our business was completely new, that he will probably not make any business and money with this new business because it was like not a very disruptive business, which it was. But it was not the business he bet on originally. So we acquired back our shares. And so what we did when we had this, when we decided to give incentive to our key employees, we gave part of our shares, and we talked also to our business angels to share part of their shares also with these 10 key people. And we explained to them that, maybe you will be less loaded in shares, but at the end, your shares will worth 3 times, 4 times better because you will have this team super motivated and aligned with you and with us. And this worked pretty well.
Did you find any points of friction on this earnout? Because I hear stories about earnouts going sideways and turning into lawsuits and people pissed off.
No,
it was just really clear. And what was it based on? Was it based on revenue, EBITDA? Like what was the earnout?
It was a multiple of EBITDA augmented by the growth of the revenue.
Okay.
So it was like more or less 2 more points if the growth of the revenue was above certain threshold. But basically a multiple of EBITDA. So it's pretty clear, pretty healthy. You don't pay the startup based on the revenue that it's making, but based on the performance the company is making, like the financial performance. It helped us, it pushed us to be lean. We had a very good gross margin, like 35% gross margin, which was like best in class at the time in the market. And once again, everybody in the company was paying attention to the spend. But the spend is not like a restaurant or trips. The spend is how you optimize your resources on a project. How you watch that this client is too much demanding. At some point, you have to say no.
Make it profitable.
Because it's very easy to satisfy your customers and to degrade your profitability.
Exactly. What were like the synergies that you found that, hey, it was the Publicis brand made it a lot easier to do business? Like what were the big value add resources that you got?
The Publicis brand definitely helped us a lot. It gave us access to
people answer the phone more often.
You remember me? Definitely it helped. I don't think there was any downside. What we did is at some point we became too expensive for some of our old customers, and this is just like the natural way of life. So you increase your price and.
What about like strategy? Did you get extra help with strategy and just thinking through go to market, things like that?
No, I guess this is like being entrepreneur.
Yeah. So it's more of giving you a platform, but just incentivizing you to keep growing.
Exactly. So no, there was no downside. The synergy was like definitely the brand. One thing also, you don't have to focus on paying your employees at the end of every month. All these paperwork, admin things is one less things you have to think about because there is a staff dedicated for that. So you can focus more on the business, which is good.
Yeah, that's a key thing. Is letting you have that autonomy. So I think that's an interesting balance that they ultimately created. You got autonomy to grow the business independently, but also got support from the large organization. Let's break that down. From the buyer-led perspective, what point of view or advice you could give to buyers to help them create a better experience for founders on their exit?
Yeah, I think, as I said, one of the reasons I think the deal worked pretty well with Publicis is that the deal was really balanced. I really believe in the yin yang in M&A. You have to, the deal has to be fair for everybody. And very often, the buyer feels that the power dynamic is in his favor. So he's going to try to push the cursors to the maximum in his favor. And maybe at the closing time, he's going to feel like he won. He's going to flatter his ego. But what I've seen, and especially in that kind of deal, is that it's not a sprint, it's a marathon. It means you're going to have to work for a very long period of time to realize the benefits and the profits of this merge and this acquisition. And if the deal is unbalanced, at some point, the seller will feel like will lose motivation. We kind of lose sight of why he did the deal, and there will be this not involvement in the business, and at the end, it will make a bad deal for everybody. And I think the good model is when 1 + 1 makes 3. This is what happened with Publicis. I think it created a lot of value for them, a lot of value for us. And when the deal is unbalanced, when you try too much to make it favorable for yourself, then 1 + 1 = 0. Everybody lose the value creation that could have happened. So yes, try to, and this power dynamic works when you're a buyer and when you are a seller. It's the same thing.
So having a good balance of what's in it for each person. And so I think a lot of that carried over with this earnout structure because it gave you potential for a significant amount of upside. What did that look like? Like, is it sort of a percentage? We can make up some numbers just to give a rough idea. But was it like, hey, here's, deal value, whatever, 50 million, then earnout comes out to like 20 million. Like what was the ratio?
So the company, Publicis is obviously listed, so I cannot disclose everything.
Yeah, just rough idea.
The structure of the deal
how much percentage?
No, but it's interesting, you're right. The structure of the deal was we get one check up front, which is a small check. But still, you've been working for 7 years, very hard, since 19 years old. You're happy to materialize this work in some way and to be able to buy a house or whatever. So this was the first check. And then there was an intermediary payment over the 3 years based on the same formula. So you were playing the formula, and obviously you're in the middle of the journey. So not the full value is realized, but they play the formula and they give you a second check based on the exact same formula of earnout. And ultimately, at the end, in our case, it was 3 years, they play again the same formula. Normally, if you do good, the total is much bigger than the first and the second check. And they were just like offsetting the 2 first check they paid. In our case, what is interesting is I'm pretty sure that what it costed to Publicis was over what they budgeted. Because when you close a deal, you say, okay, I want to acquire this company, and based on the forecast, it should cost us 50 to 80 million. And if you do very good, because it's a formula with no cap, then it costs them more than what they were expecting. But I mean, it's just like a proof that the merge worked and that the acquisition was a good acquisition. So at the end, it's a good signal. It means that Publicis is able to acquire small companies, is able to merge to create value. And yes, it costs them more than they budgeted, but it means it was a success. So not a bad signal for...
So this deal, there's actually a lot of the value is actually on the earnout.
Yeah. Yeah, I mean...
Like more than half the value was...
much more than that. I think it was like upfront check was 10%.
This is crazy.
Of the value, total value. Yeah, as I said, they were like...
I thought you were a little crazy.
They were like other options.
I thought you were a little crazy for this interview. Now,
Gambler, yeah. No, but there was other options where we were getting like 50% upfront. Typical deal, you get 50% upfront, 50% will be based on the performance. But then it would have been, for sure now, looking back, it would have been a much more earnout in total at the end.
What's wrong with you? I mean, not what's wrong with you, but
the thing, so you know,
I'm trying to absorb this mindset, right? Because it's
you have nothing much to lose. I mean,
but you're taking
no
a
family,
huge
no
risk.
Kids, so you bet for the best, and you believe in yourself. You believe in your team. You believe in the market, and you know you do the kind of same bets that
the idea of an exit. The idea of an exit is to realize value, but in this case, you're taking on a bigger risk.
We like that.
Was an interesting example. I didn't realize that it was actually huge chunk on this.
15%, but not much.
Yeah, so it's I still don't get it.
As I say, I mean, in our case, we believed more in the terms than just in the upfront valuation.
And it did pan out.
This is like so true today.
You ultimately look back and said, "Hey, we actually made the best out of that exit."
Definitely.
So,
I think, we choose the best path. I'm not sure there would have been for sure we could have been executed even more and make the numbers being bigger at the end. But in terms of path, but you know, there's also luck in that path that we followed.
Teach me as a buyer, how do I do this? If I'm looking at a company, how do I convince them to, you know, put 15% up front and really base a lot more of this on earnout?
As a buyer,
I think I think for you as a seller, you had a level of certainty. I'm just wondering as a buyer, you know, how did they get to that point to create that earnout structure? Like, did they sort of hey, Xavier is a little crazy?
As I said, I think it cost them, I'm pretty sure it cost them more than what they budgeted, but honestly, it's a win-win deal.
Yeah, because they didn't have to put in much money.
If the merge doesn't work, it doesn't cost us much. And if the deal works pretty well,
they win.
It costs them a lot, but it means you have created a lot of value for the group. And that was the goal of the group, the goal of the deal, because the deal was to transform the group.
But how did they come
the more you transform the group, the more you pay at the end, which is like pretty fair.
How did they come to terms with this? Because I don't think this is their standard playbook. Like, this isn't what they offer everybody.
2007, I think market conditions, not many players to be acquired. And
so they probably looked at
Publicis had this culture of acquire. I mean, I think they are good. They are good at being able to draft deal, being flexible. I mean, we negotiated that deal. Obviously, it was not the first version of the deal they drafted, but they were pretty flexible and ready also to take some risk and to try something that bit out of the what is done practice, market practice.
That's fascinating. You know, I'd love to talk a little bit about your current role. You know, you've had this experience, you've gone through the whole cycle. Now you run a venture fund. Now you're working directly with founders and through their journey. And I think this is a big value add, right? There's just capital, but then there's capital with the people experience. How do you kind of help and guide them to even just start thinking about this? Because I feel like it's always an interesting conundrum when you talk to founders of, you know, hey, is it purely focused on a mission and you just stay focused on a mission? You don't really think about exit. It just comes up. Or are you really thinking about exit early on? And are you sort of building for the exit? You know, what's your philosophy when you start working with these founders?
Yeah, we try to explain to the funders that the exit is not the result of a final battle. Very often they think, I mean, they push, they postpone for later. And we try to explain them that you don't build, you don't shape your exit at the final battle, but you shape it, you design it at every round where you have to fight every battle to get the best terms. And we try to explain them that terms matter more than valuation. I mean, our job is a bit schizophrenic in a way that is like, the magnet in an EV engine. It keeps changing polarity all the time.
Right.
And us is the same. I mean, you start being on the buy side. You want to enter the deal, so you want to convince the startup that you are the best investor to work with them. So this is the first approach, and then you are in the cap table, part of the deal, more or less aligned with the other investors and the funders, and you're gonna reach the next round. And in the next round, you're a seller. You're gonna have to pitch the company to other investors to tempt them, to tease them that they should be part of this journey, they should be part of this startup, and they should invest in this startup. So you turn being like from a buyer to a seller. And ultimately, if you go to the end, you reach this exit moment where you look at the waterfall, and very, very rarely everybody is aligned. There will be people on convertible notes with a discount. There will be people with liquid press. There will be people with participatings. And not everybody is aligned. It's super exciting. It's a lot of strategies, like a chess game, how you're going to handle and navigate this waterfall and this cap table to defend your interests and the interests of your LPs that trusted you in the fund. And what we try to explain to the entrepreneurs is that the value of the exit is not only in the number of shares they will get, the percentage of the cap table they will get, because very often you see entrepreneurs like fighting a lot to have like 1% more in the cap table. But at the end, it will not make a big difference. What makes the difference is the terms. And this is like the first things we try to communicate and to teach to other entrepreneurs. And the second thing is, if you look at what is the success of an exit, is it only the money you're gonna make, or is it just like the fact that you're gonna create value and you're gonna be successful, and being successful, you're gonna be able to raise money for our next journey and next adventures? And actually, very few people knows exactly how much each funder is going to cash out. But everybody on the market will be able to recognize the creation of value made by the funders with this startup, with this product, with this service. And they will be able to see that this player, big player, acquired your company because it was bringing value to this big player. And at the end, I think like that. Ultimately, what matters is not how many millions you're gonna make. It's more like, are you jumping into the journey with the right partner, the right investor that's gonna be here when everything is bright, but also during the storm? And will it help you to make a success at the end? And whether you cash out 20 million, 18 million, 15 million, or even less, what you want as a people, as a human being, is to be successful. And just like the beginning of your career, the beginning of your journey, usually you are young entrepreneurs, it's not going to be your only venture. So I try to teach them that focusing on the success is more important than focusing on just the total amount of money. And the success doesn't come from having the best percentage, the maximum of percentage of the cap table, but it's come from having the best partner to help you to thrive your startups.
Yeah, and you had a good point. Like, you have a cap table with different investors that are going to have different perspectives, different expectations, maybe different terms, and so forth. So how do you maximize or benefit the greater whole of the cap table?
Yeah, and it's not easy. I have to admit. This is our day-to-day job.
I'm learning it firsthand. The messier the cap table, the harder it is to do the deal. It's just,
but it's not easy for an entrepreneur to, which his job is to develop his business and not to focus on the strategy of the waterfall at the end, to understand all that. And that's why I think it's good when you have funds that are funder-friendly to work with you. As I said, I don't define myself as a financial guy. I'm more like a entrepreneur who likes to be part of other entrepreneur journey. And I think this where we can also make the difference compared to other VCs are going to be good also, but maybe more like focus on the return only.
What, if I was a company looking to raise money, be it VC or growth equity, what are like the terms specifically, right? Because valuation we always look at, but now we're realizing terms are more important. What are the terms I should really pay attention to, right? There's obviously like liquidity preferences,
Yeah, there's so many different terms, but definitely pref or no pref, participating or no participating makes a big change. Participating is kind of game changing. So that's super important. And then the typical good liver, bad liver, always messy. There is a lot of fight about that.
What do you mean? So let's explain this, because I think people aren't familiar. If you have a participant, now this is a funny one, right? Participating, that means you basically get your preference.
So participating, I'm gonna try to explain that in English. Be tolerant.
Don't worry. I'm gonna try the best, because I know this like in the same way. Even I know English, I still can't.
So it all comes to the waterfall and the final payment. So participating, it means you're gonna first get the percentage of your shares. So let's say you have 10% of the cap table. You're going to take your 10% of the total amount that's going to be paid to the investors and to the funders. And after that, you're going to get, so you offset this 10% from the top line.
Yep.
And after that, you're going to get, once again, your percentage with all the other funders. But the first 10% are secured.
Right off the top.
Secured for you, right off the top. And so you are playing for another round after with everybody. But in a scenario where the company is not performing as good as it should, if you run all the simulation, securing your liquid pref participating can be game changing.
Yeah,
you're going to be the first served, and you're going to be served twice.
Is it ideal to have 1x non-participating? Is that the ideal term to go for? Or
we've seen, I've seen everything. I've seen like 4x pref when the deal is super defensive. And this is at the moment where you need to have dry powder. Because the typical example is you invest in a startup, seed round, not everything goes accordingly. The company is not doing well. Not easy to find anybody else to join the next round, but the company still has some potential, but need to be like reshaped. If you are an insider of the deal, it means if you have been closed to the funder all the time, not a business angel that put his money and lost sight of his deal, then you know what this deal is about. Is it defensive or offensive deal? And you know if you have to play again to put another coin in the machine, or if you just have to drop. This works only if you are an insider of the deal, if you have been close to the funders. And at that moment, what might happen is that you're gonna cut your arm, which means like the first dollars you have invested in the deal, they're over. Yeah. But you have a chance to play for another round. Sometimes like a pay to play. It can be even worse. It can be even worse. It can be like you got 4x pref on the new round coming, and if you don't participate, your old shares become common. So it's like it's a double penalty.
Wow.
And if you're an insider of the deal, you know what you have to do. And if you have enough dry powder, which happens that some people, they did all in, play poker. They
Right.
did all in at the last round. They have no more cash for this next round. And all the value is going to come from the next round because you have 4x pref. And the company is going to start a new adventure. So you have to believe in this new adventure. Typically, you have a kind of identify potential buyer that is pretty secured. And so you know that if the company reaches like this kind of few milestone, then you have likelihood that the deal will happen. And then, because you are aware of everything, being an insider, you decide to play again.
Yes. Terms matter.
Terms matter.
Are there any other big like gotcha terms that are, things to think about besides this sort of preference stack?
What else? Most favored nation, MFN, ratchet is good also. It's a good protection. It means like if the next round is below the previous round, they will give you more shares to compensate the loss, to make it simple. So it's a good protection also.
It's good. The terms matter. How, you've gone through and as an investor, you have about over 30 exits now.
Yep.
So what advice would you focus on when it comes to like the pure exit event?
Yeah, I have a funny story about that. So one of the first deal we did with Wind One. So Wind One was our first fund, self-funded by Thierry and myself, roughly $40 million, 40. And we did this bet on a team that was developing a log management product. So a SaaS business, 2015, this is the moment where everybody is doing SaaS, and this is the beginning of this new trend, working very well. And so we bet on this team, we bet on that space, and the company is doing pretty well. They are selling their log analytics system to many companies, but unfortunately, which happens sometimes, the funders disagree, and the dynamic of the funders doesn't work. So they decide to sell quickly. They have a buyer. They haven't realized a lot of value creation from a sales perspective, but from an IT, from a product, they have a good product. And I'm a young investor, repeat entrepreneur, but young investor at the time, and the deal is pretty good. A good IRR. We get maybe like 3x or 4x in 2 years of time, so we're pretty happy. So we kind of signed the deal quickly. And what's happened is that this startup being acquired by a US company, and the valuation was not so high because the founder were loaded in shares of the company, the mother company that was acquiring the startup. We didn't see too much. We didn't pay too much attention to that. And also at that time, this US company was not what it is today. Ultimately, long story short, this US company that acquired the startup became listed on the NASDAQ. Today, it worth 50 billion on the market, and the product they sold is probably 1/3 of the revenue.
Oh, wow.
So, lesson taken is that try to be as much as possible aligned with the founder terms when there's an exit. If we would have got the same percentage of ratio of shares that the founders got, I think I would be very happy today.
Yeah.
So there was like this asymmetry, disalignment in a way. And that time we found it fair. But my lesson from this deal is that next time I will try to be more aligned with the same term than the founder.
How'd you end up with different terms? Because it was just
because it was like everybody got the same. The valuation of the company was obviously the same for everybody,
right?
But they got incentivized with shares of the mother company.
With their company, you didn't. You just got exited out with cash.
Exactly.
So if you would have converted to shares, that would have been the whole.
We could have been converted, or we could have noticed that, hey, maybe we should value the shares we are selling, you are giving in the total value of the deal.
Right.
Or we could have asked to, as you said, like to get half equity, half cash, for instance.
Yeah, because they would have probably been open to doing that, rolling over the equity.
But I'm not bitter about that. It's a good story, and I'm super happy for the.
That's a good. Well, it's a lesson learned.
But it's a good lesson to learn, like being pari passu with the founder's deal.
Pari passu. What does it mean?
Sorry.
Pari passu.
Pari passu is not something. I don't know if it's a Latin word, but pari passu means like same terms.
Same terms. Yep. Yep. Pari passu. Same terms.
We use it a lot in France. Pari passu.
Yeah. Let's go. We got to bring this in. It's part of M&A science. We got to bring in. You got any more M&A French terms?
Déjà vu.
Déjà vu. that happens too.
This deal is déjà vu.
Yeah. What is your philosophy when it comes to exiting versus double down? Because you kind of gave that example of, hey, you got this other opportunity where you can get exited out, or do you sort of play into the next journey or next round? How do you think through that? How do you work with your entrepreneurs on that as well?
Good question. I don't have like one philosophy, but what I think made us kind of successful in Fund 1 is to enter early, because we were doing like pre-seed and seed, basically. And so we were able to do multiple secondary round. And sometimes it could be like counterintuitive, because you're gonna basically sell your shares to people like Sequoia, Tiger, NGP, that are bigger, smarter than you, and you sell when they enter. So you are seller when they are buyer. So it looks like counterintuitive, because why sell when the company is doing good and when everybody wants to enter the deal and buy your shares? And typically they usually buy it with a discount. But when you enter very early in the deal, at Series B, you can do 15x. Sometime next round 30x. So this is what we've done with a startup in the mobility space. We did like first secondary 15x. So talk together with my founder, like 15x is not bad. I mean, you never know what the future will look like. So maybe we should secure a bit. So let's say like 10 to 15% of our shares. Sell it. Company keep growing. Next secondary, next round, 30x. Yeah, 30x. Hey. We have to securize a bit of that. We have to secure a bit of that. So we sell again, maybe 10 to 15% again. And ultimately, at the end, the company will do a SPAC, not a good SPAC. But in the cap table, we were probably the best in terms of IRR.
Right.
Because we have done secondary where people enter the last round, and then there was this pack and this.
So the secondaries actually helped you out.
So we always have this philosophy of securing a bit and keeping the rest for the potential.
Right.
And I don't know if it's a philosophy or a theory. I didn't make it a theory, but looking back, it worked pretty well.
Right.
So we keep doing that, and I can give you a counter example.
Sure.
Because the context really depends on the performance of the company. So in that case, first situation I just described, the company was not yet profitable, but an amazing growth and being acquired by a big US player. It was one context. The second context, second example is a US company. I've been board member of this startup for 3-4 years in the mobility space also. Based in San Francisco. The company is doing very well. We entered, the ARR was 30K, and today they are doing 32 million ARR. So huge growth. And this is the second time that growth equity fund is joining. So basically, a few weeks ago, we had this option of getting all our cash back, or stay in the adventure for the next round. And it was a lot of few millions, actually. The line was few millions. And I decided to stick to the company and to stay in the adventure, because I say, okay, I get these few millions. Is there a better way to invest these 2 millions than staying in the adventure? I know the startup, I know the founder, I've been board member. I guess I know the market and I know the potential of the market. And I guess the growth equity fund that's joining the adventure did all his due diligence and is pretty sure it's a growth equity fund. So, it's not as early stage.
Yeah.
The risk is limited. And I'm sure they did all the due diligence to make sure that they will do a 2 to 3x in the next 3 to 4 years.
Right.
And today, I'm not sure that I could find right away a better investment than to stick to the founder team I know, I trust, and the market I know and I trust. So in this case, we decided to stick, and it's been like 2 to 3 rounds that we could have cashed out, but we decided to stick to the adventure.
And it's looking good.
Yeah.
That's
Because
good.
the company is profitable now.
Right.
Profitable is like self-finance.
That's an interesting view on that from the investor perspective of, you have your own view on exits, right? There's a founder view, but he's got like a different perspective because he's an operator and he's playing the long term versus you have your different angles of diversifying your risks, whether partial versus wholly, and looking at that.
And the luxury is like when you can decide. When we did secondary before, it was because we had like obvious opportunities to cash out and reinvest this money in new opportunities. But right now, this is fund one. Fund two is already a big fund. Doesn't need to be more finance. We have plenty of LPs now in this new fund.
True.
So
you assess it against your alternative bets that you could be making.
And I really believe in this rule of 40. I don't know if you're familiar with that, but this startup is one of the best in class following this rule of 40. Pretty safe business now.
Right. That's true.
With B2G.
So rule of 40, basically your combination of your EBITDA margin plus your growth percentage equals and ideally you want to be over 40.
Yeah.
That's your rule of 40.
Either your growth is like 30%, but you are break even on EBITDA, or you're positive on EBITDA and your growth is like 30%.
Is there, I'm curious because I feel like I run a business right now. We're right at 10 million ARR, like 50 people. And we always think of rule of 40 as well.
Congratulations.
But we're always focused on growth. Like we're pushing to get the 40% year over year growth. So it's intentionally operating right at break even. Is there a spot, from your perspective as an investor that, maybe there's like a sweet spot between it, right? Because you got to kind of align. You could push. I could literally go.
Question. I give you my perception. I like when the EBIT is below zero, but very well controlled. It means like you don't need to be above. If everything is under control, it's better you be a little bit below, and it will help you to grow faster. But you can feel as an investor, and you can talk to the founders, you can feel how it's in control of the global trajectory of the company. And you feel like, okay, so, you're going to be like -5, -10 and the EBIT, but it's a big growth. And you know that at any time, you can cut some cost and being break even, which is kind of game changing in the perception of the startup if it has to be acquired or financed.
If I ask that question a later stage investor, they might give me a different response. But
it depends. Exactly, it depends. I mean, you tell me like 5 to 10, this is what I will do. If you tell me I'm doing 100, I will probably give you a different answer.
Yeah, no, that makes total sense because we've had a couple of years where we're doing 30+% EBITDA margin. So we built cash reserves. Now it's easy to sit there, teeter, or run -5, 10%. It's like not a big deal. We have cash on hand. So I think you're right. When you kind of know your total financial picture is sound, then you prefer that push forward on growth, which totally makes sense.
And another thing I will look at is your churn.
Oh, the customer,
the churn and the value of your contract. I mean, this other startup I mentioned from San Francisco, it's a B2G business. So it's hard to enter, business to governmental. It's hard to enter, but then it's super resilient. The churn is very low. And the startup has an history of a very, very low churn. Like they have actually a positive churn because they are upselling their current customer. And when it's been like this for 5 years, it means like it's pretty safe. I mean, and you can take more risk because you know that you're not going to accumulate a downside of the market, and at the same time, customers are going to drop. They are very sticky. They had to integrate the product with their system. So churn will always stay very low. And it's like another way to remove the risk from a deal and assess an investment.
What are the biggest reasons your investments go sideways? Is it because you had that reference earlier, like the founders don't get along and they want to sell?
Yeah.
Like,
I mean, you name it. Like you cannot control everything. This is why it's called capital risk.
Yeah,
You see?
there's
Functional capital.
macro trends you can't control. Like, you know.
No, you cannot control everything. And we've seen, we have invested in startups where there was couple working, managing a couple, man and woman, managing the business. Statistically in Paris, 50% of the couple split.
Yep.
So you know that on top of all the risk, market, technology, whatever, you add this risk on top. So I had like one bad example of a company going sideways because the couple split, and I have another example of a couple working together and did amazing. So I have no philosophy, but I know for me, when there is a family involved in the business, it's an additional risk.
That's an additional risk factor.
Like that. Yeah. I had like one case, I did more than 80 investment, probably 100 now, is the second one. I had one example of fraud.
Oh, wow.
Like guy not disclosing the right information, or even disclosing the fake information. It happened once on a very small deal. I didn't lose much, but it happened. But it's very, very rare. I mean, this business is all about reputation also. So
that's so true. You get a reputation for a good investor. I mean, I'm talking to investors now, and it's like number one thing I'm looking into is.
Yeah. And then other reasons to go sideways, there are multiple, but it can be the market in a way that you bet on, you're relying too much on Apple, for instance. And Apple change is rules, general, I forget the name, like CGV, you call it in France. Apple is changing this,
like,
how do you call
terms,
it? Like terms.
Terms of use.
So another example is I did once a startup back when I was in the US, B2C apps, and Apple is changing its terms, and the apps can no longer be on the Apple Store. This happened to many startups actually. So this is when it can be sideways, and it's very hard to predict. And then the typical way is the technology doesn't work, because the technology is too long to be mature, so investors get bored and give up. Biggest competitors, like you were working on something and a bigger competitor is coming and kills you, or can be a completely bigger change of trend. You were in the translation business. You did amazing translation apps, and ChatGPT is coming, and you're dead. And this is going to happen with many. I mean, because of the AI, this is going to happen to many companies.
So, are you in the business of taking calculated bets, or are you gambling?
No, I'm really calculating bets.
Calculating bets, but there's
IQ and EQ. So the EQ is important. We have to believe in the team, to have a fit with the team, because we're going to work with the team. We're going to have to love the market, but there's always someone in the team that is going to take a spreadsheet and run all the simulations, all the scenario. And at the end, I understand, Xavier, you really like this deal, but look, it doesn't work.
So
the market is too small. And then we don't do the deal.
Fair enough. Maybe I'm too much of Silicon Valley culture. I always imagine them on a roulette table, just putting chips and numbers.
No, but maybe we are not following enough our intuition sometimes. I think Jensen Huang, the CEO of NVIDIA, was telling that Americans, they focus on the 1% reason why to make the deal, when Europeans focus on the 99% reasons why not to make the deal.
Sounds fair.
So we try not to follow that rule, but I kind of recognize some pattern in that.
That's funny. I love that. I I got to ask, Xavier, what's the craziest thing you've seen in M&A?
Definitely easy answer, the SPAC. I think it's dead now. It's a good thing that it's dead because it was like, for me, it was an aberration. It was the pinnacle of what can be the worst in finance. Completely misalignment between the sponsor and the investor, signing a blank check, not knowing exactly what will be in the package at the end. It's like you're signing to get married, but you don't know who will be the bride.
Yeah, that's actually
So
really
it
great
was
way to put it.
It was crazy. For me, this was gambling. Hey, look, this company did a SPAC and did amazing. Let's do a SPAC. Because one did good, and I think 99 did bad. So it was like what the worst could be done in finance. And the only winners in that transactions were the bankers and the lawyers.
Yeah,
These guys made tons of money with SPACs.
absolutely. This SPAC craze. You're right, because there's a lot of fees to go to doing a SPAC and just public, and so it wasn't kind of capital efficient. I mean, when you look at it, that's a big chunk of expense to run through a SPAC. And
I follow some deal. I was part of the deal, and the fees, the lawyer fees and the banker fees were like something like 10 to 15% of the total value of the deal.
that's what I mean. Gone
And
right
I'm
off the
talking
bat.
about big numbers, like in the billions. So,
Not very capital efficient.
yeah. So yeah, SPAC definitely.
Hey, Xavier, this has been great. I appreciate you taking the time to have this conversation. I
Thanks
learned a
for
lot.
having me.
You helped me become a better M&A scientist. Those of you still tuned in, fellow M&A scientists, I appreciate you listening and staying tuned. Love to hear what you think. This is another different interview, different topics. Reach out to me on LinkedIn, like any of the feedback. If you got other topic ideas, just general feedback's always welcome. And the criticism, I'll take it. That's how I get better at doing this. With that, till next time, here's to the deal.